So last week, the 13F filings for major investment funds got released, and it was revealed that Warren Buffett's Berkshire Hathaway made one single new investment, which was in Constellation Brands. This is an alcohol company that owns some of the most popular brands of beer like Modelo and Corona, as well as several other wine and spirit brands. However, the vast majority of their sales come from their beer segment, roughly 85%, as we can see here in their most recent quarter. Modelo actually recently became the number one selling beer brand in the United States, taking the top spot from Bud Light. The company earns the vast majority of its revenue domestically in the US. However, they brew all their beer in Mexico before importing it to the US for it to be sold to retailers who then sell it to end customers. So it's an interesting investment because this company initially dropped about 17% in early January of this year after a bad earnings report where it missed estimates and it cut its guidance, and then fell even further in the following month as the Trump administration ended up imposing 25% tariffs on imports from Mexico and Canada in February. So now all the beer that Constellation sells, which gets imported from Mexico, is subject to tariffs, which in theory would make the products more expensive and reduce their sales. It's estimated that tariffs of 25% would mean the price of their beer would have to rise by 12% to fully offset the increased costs. Now, it's worth noting that beer sales have historically been resilient to price increases. For example, in 2006, they hiked prices by 6%, but their beer volume growth still outpaced their peers. But we're in a different time now where consumers are more cautious. They're worried about things like inflation, so they're cutting back on spending. And back in 2023, Constellation's management said that this type of consumer environment would be overly sensitive to pricing actions. So they're only planning for 1 to 2% price increases in their beer segment going forward. And as we can see over the past few quarters, they haven't raised their prices as much as they previously had, which of course would impact their sales and their operating margins. So this is why tariffs present a particular problem for them. Historically, they've been comfortable raising the prices of their products just slightly year over year, but tariffs would cause this big shock, which is not good in an environment with a cautious customer. So what we're likely to see now is lower margins going forward and also probably lower volume growth going forward. Now, given the size of this investment, there was some debate as to who within Berkshire actually made the decision to buy Constellation Brands. The investment is about $1.2 billion in total value when it was initially made, which is about half a percent of Berkshire's overall portfolio. And it's rumored that investments under $1 billion in value are typically made by Warren Buffett's portfolio managers, which are guys like Todd Combs and Ted Weschler. So it's possible it was them. However, the investment must also align with Buffett's overall investing principles of buying high quality businesses with defensible economic moats at fair prices. So if we take a quick look at some of the fundamentals for Constellation Brands, there's a few things that immediately stand out. One is their profitability ratios. As we can see, their margins across the board are much higher than the median for their industry. As we can see here, their operating margin of 32% is much higher than the median, which is 21%. And I have excluded unprofitable companies, so unprofitable alcohol companies from this calculation as well. So it's really a apples to apples comparison. The net profit margin of 25% over the last 12 months is much higher than the industry median of 15% as well. And the reason they're able to achieve this is also the reason why the tariffs are such a big problem for them, which is that their breweries are located in Mexico. So things like labor costs, taxes, regulatory costs, all those things are going to be much lower versus a company like, say, Molson Coors that does their manufacturing in North America. They're going to have much higher operating costs. And it's also trading at a historically cheap valuation multiple. If we take a look at the enterprise value to EBITDA multiple for this company, we can see usually historically it's averaged around 15x with some variance along the way, but recently it's come down a bit. Right now it's trading at around 11 and a half enterprise value to EBITDA, which is historically cheap for this company. Now, what's also important context to know for this investment is what's been going on with alcohol stocks overall and why they've been performing so poorly over the past year. Now, before I get into that, I wanted to give a quick shout out to the sponsor of today's video, which is Moomoo. Moomoo is a digital trading platform designed for individual investors that also provides tools and resources for analyzing analyzing the financial markets. For example, you can view Warren Buffett's latest holdings and the performance of his portfolio. This helps you follow Buffett's actions and keep tabs on what the super investors are doing. There is also the institutional tracker feature, which reveals which stocks and ETFs top institutions are holding, along with industry breakdowns, recent additions, and even sold out positions. And if you want to invest in US stocks, Moomoo is one of the most competitively priced brokers in Canada. You can invest in US stocks and ETFs at a cost of just 0.99 cents per share. There's no minimum deposit requirement and no account maintenance fees. And for Canadian stocks, the cost is just 1.49 cents per share. And you can also earn returns on idle funds 24 hours a day. During the interest rate cut period that is coming up, new users can still enjoy 6% APY with the Moomoo Cash Plus program for 2 months. And Moomoo supports deposits and withdrawals as you go, so you can make deposits and withdrawals at any time. They're offering new users a welcome bonus right now with two other potential rewards, all of which can be enjoyed at the same time, up to $150 in stock cash coupons, which is basically cash back you receive when you purchase shares. If you deposit $100, you get a $50 stock cash coupon, and if you deposit $2,000, you get a $150 stock cash coupon, as well as a transfer in bonus where you can get up to $2,300 in cash rewards on your initial transfer amount. Terms and conditions do apply. So click the link in the description box of this video and feel free to use my link to register. Thank you to Moomoo for sponsoring the channel, and now let's get back to the video. So if we zoom out and look at the past year or so and look at other big alcohol stocks like Molson Coors and Anheuser-Busch, we can see that the sector overall has been underperforming. All these stocks are down over the past year. And part of this is because there was this pretty drastic sentiment shift that occurred that was sparked when the US Surgeon General called for there to be cancer warnings included on the labels of alcohol, which really brought to life the true health risks associated with drinking. Without getting too far into the science of it, alcohol is said to be the third leading preventable cause of cancer after tobacco and obesity, and that even low levels of alcohol consumption can cause cancer. But what's really the biggest trend impacting the industry right now is how younger cohorts aren't drinking nearly as much as people of their age used to. The percentage of US adults age 18 to 34 who are considered regular drinkers has fallen from 49% to 38% over the last 20 years. And a big reason for this change is changes in the perceptions of the health risks associated with drinking. As we can see here, the age 18 to 34 cohort has seen a significant uptick in people believing that drinking is bad for your health. So now, because of this, it's generally accepted among investors that the alcohol industry is going to be declining for the next several decades. However, this doesn't necessarily mean that all alcohol stocks are going to be bad investments. In fact, it can actually mean the exact opposite. For example, the tobacco industry went through a dramatic change over the past several decades where the health risks became more well known by the general population and people stopped smoking. But despite that, stocks like British American Tobacco did very well, and Altria Group, which used to be called Philip Morris, performed extremely well over the next few decades. The best industries to be invested in are not always going to be the ones that are widely regarded by investors as the best industries or the fastest growing industries. In fact, there's pretty convincing evidence that chasing returns in those fast growing industries actually leads to underperformance. What's more important is understanding the value you're getting for the price you're paying when you invest in these companies. And Constellation actually fits into the typical profile of the consumer staple type companies that Berkshire Hathaway has historically invested in, which are companies with iconic brands that have been around for a long time that consumers will probably keep buying even if their prices were to go up a little bit. Other consumer staple companies that they own would include companies like Coca-Cola, which they've owned for a very long time, and Kraft Heinz. And what both of these companies have in common is that they own some very iconic brands that are all market leaders within their respective area. And they're also mature companies with pretty low revenue growth rates, as we can see here with Kraft Heinz. They've had pretty much stagnant revenue growth for several years now, and Coca-Cola as well has had revenue been growing a little bit, but it's mainly single-digit revenue growth year over year. But they're also companies with very good margins, as we can see for Coca-Cola. Their margins across the board, so operating margin, EBITDA, and net margin are all much higher than the industry peers. And then with Kraft Heinz, their margins are actually pretty average for for their industry, but their free cash flow generation is very strong, around 3 billion per year in free cash flow, which is pretty high for a company that's valued at around 36 billion. And it's a similar theme with Constellation. As I showed before, their margins are consistently higher than the industry median, and they own some of the most iconic beer brands, brands like Corona and Modelo, which has endowed them with some pricing power. Historically, they've been able to raise prices in the low single digits per year, and their shipment volume has continued to grow along with it because of the strong demand for their brands, especially Modelo, which is now the top selling beer in America. But it's also worth pointing out that their other segment, their wine and spirit segment, has performed very poorly. This segment is generally made up of higher end wine brands, and over the past few years, sales of high end products in pretty much any industry have really suffered because, like I said before, people have become more focused on cutting back on spending in order to save money. So, what the Berkshire team probably saw in Constellation was a company that sold off throughout 2024 because of some reported weaknesses in the alcohol industry overall, such as the health risks becoming a more front and center issue, and also poor sales in their wine and spirit segment, but still a very strong beer segment that's growing and makes up the vast majority of their revenue, anyways, and also a company that has very good margins. Now, to get an idea of how attractive this company is priced right now, let's actually do a valuation, which now is a good time to do a valuation because it has dropped in price so much recently. And it actually probably dropped in price after Berkshire Hathaway made their initial investment because we know that they owned their shares, their $1.2 billion investment back in at least December, so the end of December of 2024. And it really dropped in January and then February of this year. So their investment is probably in the water quite a lot right now, but that's just short-term declines. We'll see what the company is actually valued at right now. So this is a discounted cash flow tool. This will help us put in assumptions so we can see how much the company is worth given different assumptions about revenue and operating margin. So we'll do a 5-year projection here. And at first, we'll assume a 3% revenue growth rate with, say, 32% operating margins. We'll increase the tax rate to something more reasonable, so 14%. And then we can leave everything else the same, but I do want to change the terminal multiple because, like we showed before, historically, this company has traded pretty much bang on a 15x terminal multiple, which is enterprise value to EBITDA. So we'll calculate this. And what we're going to see is that the company is pretty undervalued under this scenario. This gives an intrinsic value per share of about 250 US dollars versus $176, which is the current price. Now, obviously, the big risk that you're facing with this company right now is the tariffs on the Mexican imports and how long those are going to last for. If it lasts 1 quarter, that's not really a big issue, right? They have one bad quarter and then they can recover from that going forward. But if it lasts a year or even 2 years, no one really knows how long it's going to last for. That's the main wild card here, and that's really the risk that you face and why it's sold off so much. So what can we do? Well, what we can do is we can model different scenarios. So let's assume a more pessimistic scenario of 0% revenue growth for the next 5 years. So say they have a decline in the next year and then they increase a little bit going forward, but overall over the next 5 years, it's 0% revenue growth. And they're also going to have lower margins because of the tariffs. So the tariffs are lowering their margins and they're also causing lower volume growth, which leads to 0% growth. I do want to leave the terminal multiple the same just because I think giving it a lower multiple, like something like 10, which it's never really traded at, would be a bit too pessimistic, but we can even get a little bit more pessimistic, let's say 12% terminal multiple. So under this, the company is overvalued at this price point, but it's not too overvalued, right? Intrinsic value of 152. So from this, we can say reasonably this company is probably worth somewhere in the range of 150 to $250 per share, which is a pretty big range, but it does give us something to work with. And even if we can change this to, again, what the multiple has historically been, now it's back to being a pretty good price point. So, yes, the tariffs are a problem for them. But what I think is if you're thinking more long term, you're thinking, say, 5 years out for this company, by that time, the tariffs will almost certainly be gone. And the company can get back to what they've done historically, which is raising their prices 1 to 2% per year, which they have historically been able to do because of the strength of the brand that they have. And then also volume growth, right? Say 2% volume growth a year, which should allow them to grow revenue around 3 to 5% annually, I'd say, over the long term. So, the way I see it, this is really a classic value investing case where you have some near term headwinds causing an otherwise fundamentally sound company to look like a bargain. But let me know what you guys think. Do you think that this is a company that's worth looking into? Have you been interested in Constellation at all? I'd love to get your thoughts and get a discussion going. But otherwise, I hope you did enjoy the video and you got some value in it. If you did, then please leave a like. And if you're new to my channel, I'd appreciate it if you would consider subscribing. And I'll see you guys in the next video.